In this lesson, we'll start introducing you to specific types of derivative securities. The first will be forwards. But before we do so, we need to establish some ground rules to define our market. First, our market contains a risk-free investment that will never default. In the real world, we often speak of U.S. Treasury securities as risk-free investments, and they're probably as close as you'll find to truly risk-free. But in the real world, there is a tiny chance that the U.S. government could default on its obligations. In this class, we assume that risk-free really means risk-free. Next, we assume that it's possible to borrow or lend any amount of money at any time using risk-free securities at the risk-free rate of interest. To keep things simple, we'll assume that there are no transaction costs or taxes, both of which would add complexity. Finally, we assume that our market is free from arbitrage. We talked about arbitrage in a prior lesson. Essentially, it means that there's a possibility of earning a positive return at zero risk through market trades. Since we have a risk-free investment in our world, which is not considered to be arbitrage, we define arbitrage slightly differently here. We say that arbitrage exists if you have a combination of transactions that has no cost, no possibility of loss, and certainty of some profit. And so to speak, it's a free lunch. The first derivative that we'll discuss is called a forward contract. A forward contract is, as its name indicates, a legal binding contract that obligates the holder to buy or sell an underlying asset in the future at a price set by the terms of the contract. For example, you might buy a forward contract on the price of corn that obligates you to buy 10 bushels of corn 1 year from now at a price of $15 per bushel. No matter what happens in the corn market between now and then, you're required to fork over $150 in 1 year and you'll receive those 10 bushels of corn. In a sense, this is a very simple concept. You're just following the terms of an agreement between two willing parties. We'll talk later about futures contracts, which are very similar to forwards, except that they are more standardized and priced somewhat differently. When you think about derivatives, I want you to start thinking about the cash flows involved with satisfying the obligations defined by the derivative. The cash flow at the inception of a derivative position is the cost, and the cash flow at the end is the payoff. Many derivatives, including forwards, are settled not by the actual delivery of the underlying security, but by a cash settlement that is economically equivalent. For example, let's go back to our 10 bushels of corn. If you recall, in our example, the forward contract obligated us to buy 10 bushels of corn at a price of $15 per bushel. What if 1 year from entering into that contract, the price of corn is actually $17 per bushel? In this case, we would come out ahead, because we would be buying something for $15 that is worth $17. If we wanted, we could turn around and sell that corn immediately in the market for $17 per bushel, netting us a profit of $2 per bushel, or $20 in total for the 10 bushels. If we're not interested in actually taking delivery of all of that corn, we might have it written into the contract that a cash settlement will be made instead. This means that rather than paying the other party $150 for 10 bushels of corn, the other party would keep the corn and simply pay us the $2 per bushel that we would have realized by taking the corn and selling it in the open market. In most cases in this class, we will be dealing with derivatives that are settled in cash in this manner. In the real world, this is the more common approach. It's much simpler and avoids logistics like needing grain silos to store your accumulated corn. The spot price of a security is its price at any given point in time. In our example, the spot price of corn 1 year from now is $17 per bushel. Our payoff in the cash settlement from our long position in the forward was $2 per bushel, which is the spot price minus the forward price defined by the contract. Our counterparty in this deal has a short position in the forward, and their payoff is negative $2, the forward price of 15 minus the spot price of 17. The payoffs of each party are always the negative of each other, which makes sense. This slide contains another example using a stock index, which has similar results. Payoff diagrams can be very helpful in interpreting derivatives. The diagram shown here is based on the stock index example from a prior slide. In that example, the forward price was $1,020 and the eventual spot price was $1,050. The upward sloping line here represents the payoff for a long position in the forward. The eventual spot price is shown on the x-axis and the payoff is on the y-axis. When the spot price is exactly equal to the forward price, which again is $1,020, there is zero payoff on the forward position. The long forward holder would simply be buying a security at its fair market price, so there's no additional cash flow from the forward. As the spot price increases past 1020, the long forward holder receives $1 in positive payoff for every dollar that the spot price increases. It's a line with slope 1. Of course, if the spot price drops below 1020, then the long forward holder has a negative payoff that increases dollar for dollar as the stock price decreases. Theoretically, if the underlying security value goes to 0, then the long forward holder has a negative payoff equal to the negative of the forward price. The short forward holder has the exact opposite payoff to the long forward holder. So the payoff line is a line that crosses the x-axis at the forward price, but with a slope of -1. Let's compare two ways of ending up with a security after a certain time period, let's say 6 months. We could either simply buy the security today, in this case a stock index, or we could enter into a forward contract to purchase it at the end of the 6-month period. Recall that the price of the index today is $1,000 and the forward price in 6 months is $1,020. If we buy the index today, it costs us $1,000 today. If we decide to buy the forward, it costs us nothing today, but it's guaranteed to cost us $1,020 in 6 months. Since both positions result in the exact same outcome 6 months from today, we own 1 share of the index, then both of these options must be economically equivalent. Let's compare the cash flows, assuming we have no cash today and need to borrow some cash to enter into the transaction. To buy the index today, we would need to borrow $1,000 at the risk-free interest rate of 2%. After 6 months, we would need to repay our initial $1,000 plus 6 months worth of interest, which comes to $1,020. On the other hand, if we buy the forward rather than buying the index, we can take that $1,000 that we borrowed and invest it at the risk-free rate. After 6 months, our investment is worth $1,020, which we use to satisfy the forward contract obligation since that's the forward price. This means that we have a relationship between the current price of the stock and the forward price. In order to be priced fairly, and in the absence of dividends, which we'll encounter next, the forward price must equal the stock price increased at the risk-free interest rate. We see notation for this at the bottom of the slide. The forward price is denoted by capital F, with subscripts indicating the beginning and ending of the time period covered by the contract, so time 0 and time capital T. This equals the current stock price, denoted by capital S sub 0, times an interest factor of e raised to the power of the risk-free rate R times the time period T. What if our underlying security pays dividends? In this case, it does make a difference whether you buy the security today or enter into a forward contract, because you may lose out on some dividends during the time period if you choose to buy the forward instead. In our example, the $1,020 would be an unfair price. You should expect to be compensated for those lost dividends. Thus, the forward ought to be cheaper than if there were no dividends. To make this a fair deal, we reduce the forward cost of the security by the value of the interim dividends accumulated at the risk-free interest rate until the end of the period. For discrete dividends, as most are in the real world, you would take each individual dividend and accumulate it at interest until the end of the period. For continuous dividends, which are largely theoretical but approximate the dividends paid by stock indices, this is because dividends are paid throughout all the time period for an index of many stocks, you would determine a dividend rate denoted as lowercase delta and subtract it from the risk-free rate R in the forward equation. This dividend rate is essentially treated as a negative interest rate, as it continually erodes the value of the stock. With a continuously compounded dividend rate, if you buy 1 share of stock at time 0, you will essentially have e to the delta t shares of stock at time t. If the dividends are automatically reinvested, this is exactly what you'd have. If the dividends are paid in cash, you will have cash equal to e to the delta t minus 1 shares of stock. So we've talked about 2 different ways to buy a stock. Either just buy it, or buy a forward contract that allows you to buy the stock for a specified price at a specified future time. If you buy the stock outright, you pay at time 0 and you receive the stock at time 0. If you buy a forward, you pay at some future time t and you receive the stock at that future time t. Can we mix these payment and receipt timings up? Well, it turns out that we can. Under what's known as a fully leveraged purchase, an investor borrows the amount needed to pay for a stock at time 0, then repays the loan at time t. So the stock is received immediately at time 0, but payment is deferred. The downside, of course, is that you incur interest on the amount borrowed, so your payment at time t is higher than the current value of the stock by that interest amount. We also have prepaid forward contracts, which we'll be talking about quite a bit in this course. As the name suggests, this transaction involves paying for a stock now at time 0, but receiving it at a future time t. It's the same as a forward contract, except that you pay at the beginning of the period. As you might guess, you wouldn't pay the forward price of the stock since you're paying for an advance. But how much would you pay? How do we value prepaid forwards? We'll find out next.